726.
726.
That's the price to earnings ratio of Amazon.
Yeah, but at 726, does that even mean anything anymore to anybody?
No, I mean, above 500, above 200.
Come on. Because that means that you would have to own the stock for 726 years. And assuming that they earn the same amount of money every year that they earn today,
right,
they would earn this for 726 years, and you'd finally make your money back if you bought a share of Amazon stock. I mean, 726.
I mean, people who bought the stock 3 years ago have made their money back and then some. They've doubled their money, which is the reason that people had bought it. They had faith. But it's interesting. It's held that highest in the S&P 500 title for about 9 months, but the PE has been high not just for that period of time. That's just because equity residential, which was the most expensive stock, is not around anymore. Masco is number 2, by the way. I did a little screen here. Netflix number 3, Host Hotels, and Range Resources. Kind of a motley crew of expensive stocks there. As I say, shareholders have hung in, and the company's argument, as you well know, has been we're investing in our future. We're investing in the next phase of growth. Operating margins are going to expand as a result. And shareholders so far have largely bought that argument on this faith that, yes, the business is going to expand. And the top line has been expanding. Revenue has been expanding at the company. The main thing they've been investing in the latest surge has been warehouses, as Amazon sort of becomes this fulfillment company, not just for the products it sells itself, but for third-party products. It's seen a gain of over 50% in sales of these, or around 50% in sales of these third-party products. And so the question going forward is it going to continue to see that kind of growth? eBay has really done a good job with expanding its margins by selling stuff not from itself, but from other people that use its site as a portal and as a sort of fulfillment device.
And Amazon.com also has a cloud services business, right, where they basically host the operations of a variety of other businesses, right, because they have so many servers, so many computers, that they have enough power and enough spare capacity, perhaps, to serve hundreds of other businesses.
Right, and that actually paralleled what we're seeing now, because about 8 years ago, Jeff Bezos decided they were going to do this big push into the cloud computing business. He threw a bunch of money at it, so it's similar to what we've seen now, and it ended up paying off. The margins did indeed expand.
Right, margins are good in that business, and the growth rates are higher in that business.
Right, and so that's what shareholders are sort of hanging on for this time, that they see the parallel situation, this surge of investment in a particular area, and then it starts to pay off with the operating margins widening in that area.
Is it possible that investors, when they also look at Amazon.com, what they've done is they basically transferred the entire wealth of the book buying industry to an online purveyor? Because we know that, Borders, that's gone the way of many businesses. And you look at the big mass bookstore chains, Barnes & Noble is really the only one that currently exists. All of the bookstores have now migrated online, and all that value now is at Amazon.com, ostensibly.
I mean, that's certainly part of it, although Amazon's business now is so much bigger than just the book business, but it is really dominant in that area. I mean, you could argue...
And it's got the streaming video services.
Exactly. You could argue that it is the dominant e-commerce company, period. And so people are betting sort of on that brand name and that dominance in that area, as well as the numbers behind it, and betting on this expanding operating margin.
Imagine that, $21 billion for the fourth quarter of 2012. $21 billion for the quarter.